Two people apply for the exact same credit card on the exact same day at the exact same bank. One gets approved in under a minute, a $15,000 limit, and a card with no annual fee waived automatically. The other gets a $1,500 limit, a fee they have to call in and beg to remove, and an APR nearly 10 points higher. Same bank, same product, same application form. The only difference is a number most people have never actually seen move. And today, we're going to show you exactly how that number gets calculated and exactly how to force it in your favor. Banks don't advertise this, but every customer gets sorted into an invisible tier the moment they apply for anything: a card, a loan, even a checking account. Your tier decides your interest rate, your credit limit, whether a fee gets waived with a smile or fought over for 20 minutes on hold, and whether the next offer that lands in your inbox is a genuine upgrade or a trap designed to keep you exactly where you are. Most people assume this comes down to income. It doesn't. A person earning $200,000 a year with a maxed out card gets treated worse than someone earning $45,000 who pays on time and keeps their balance low. It comes down to a handful of specific numbers you can actually control. And by the end of this video, you'll know exactly which ones to move first and in what order. If you're new here, hit subscribe. We drop videos like this every week so you can stop guessing about money and start actually understanding how the systems around you really work. Picture 4 doors, side by side, and everyone walking into a bank, whether they know it or not, gets quietly sorted into one of them before they even reach the counter. Door 1 is subprime, credit scores generally under 620. If that's you, expect APRs north of 25%, tiny starting limits, and annual fees that never get waived, because the bank isn't trying to keep you happy. It's pricing in the real risk that you might not pay it back. Door 2 is near prime, scores roughly 620 to 659. The APR drops a little, the limit grows a little, but you're still treated as a maybe, approved, but watched. Door 3 is prime, 660 to 719, and this is where the real shift happens. Fee waivers start getting approved on the first phone call instead of the third. Pre-approved offers start showing up in the mail instead of you having to apply and hope. And door 4 is super prime, 720 and up. At this tier, the bank isn't managing risk anymore. It's competing for you. Limits jump into 5 figures. Your APR lands in the high teens instead of the mid-20s. And retention specialists get authorized to waive almost anything just to keep you from closing the account and taking your business to a competitor down the street. And here's what makes this matter so much. Most people have no idea which door they're standing behind, or that the doors even exist. They just accept whatever rate and whatever limit they're handed, never realizing the exact same bank would offer them dramatically better terms if a single number on their file were different. And this isn't unique to one bank or one card issuer. The same 4-tier structure sits underneath auto loans, personal loans, and mortgage pre-approvals too. Learn to move through these doors on a credit card, and you've learned how to move through every one of them. But before you can move up, you have to know what actually decides your tier in the first place. And it comes down to 5 numbers, weighted in an order almost nobody gets right. Here's the part almost nobody explains clearly. Your tier isn't decided by one number. It's 5 factors, and they're not weighted equally. So treating them equally is where most people go wrong. Payment history is the biggest piece, worth about 35% of your score. And it's not about whether you pay in full, it's simply whether you pay on time, every time, without exception. Even one payment 30 days late can sit on your report for years. Credit utilization is next, worth about 30%. That's the percentage of your available credit you're actually using at any given moment, and it moves faster than almost anything else on this list, sometimes in a single billing cycle. Quick gut check. Do you actually know your own utilization number right now? Most people have no idea, and it's the single fastest thing on this entire list to fix. Length of credit history is worth about 15%. How long your oldest account has been open, which is why closing your first credit card is almost always a mistake, even one you don't use anymore. Credit mix, meaning cards versus auto loans versus mortgages, is worth about 10%. The bureaus like seeing that you can handle more than one type of credit responsibly. And new credit inquiries make up the final 10%, but here's a distinction that trips people up constantly. A hard inquiry, the kind that happens when you formally apply for something, shaves a few points off your score for about a year. A soft inquiry, like checking your own score, or a bank pre-qualifying you before you apply, does nothing to your score at all. Most people obsess over paying down debt, which does matter, but they completely ignore utilization. And utilization is the one lever you can move in 30 days, not 30 months. And to show you just how much that one lever is really worth, let me introduce you to two people who look completely identical on paper, and aren't. Let's make this concrete with two people. Sarah and Marcus both earn $58,000 a year. Both have been customers at the same bank for 3 years. Both have a $6,000 credit limit, and both pay their bill in full every single month. On paper, to a human loan officer, they'd look almost identical. But Sarah keeps her balance under $600 at any given moment, a utilization rate under 10%. Marcus lets his balance ride up to $4,800 before paying it off in full at the end of the month, a utilization rate near 80%, even though he never actually carries a balance or pays a cent of interest. To the algorithm sorting them into tiers, they are not close. Sarah's low utilization puts her firmly in the prime tier. Marcus's high utilization, despite the same income, the same limit, and a flawless payment record, keeps him locked in near prime. Same bank, same branch, same paycheck. A completely different APR on file, a completely different set of pre-approved offers landing in their mailboxes. And Marcus has no idea why, because nothing about his behavior feels reckless to him. And this gap compounds. 2 years from now, when both of them apply for an auto loan, Sarah's prime tier score qualifies her for a rate around 6%. Marcus, still stuck in near prime because of a habit he doesn't even know is a problem, gets offered closer to 11% on the same car, the same loan amount, the same term. On a $30,000 auto loan paid over 5 years, that gap alone costs him more than $4,000 in extra interest over the life of the loan. Money that never had to leave his pocket, lost entirely because of a number he never once checked. So why wouldn't the bank just tell Marcus? Why keep the whole thing this quiet? There's a reason. And it isn't the villain story you're expecting. This isn't a conspiracy, and it isn't the bank hiding something maliciously. It's simply not in their interest to make it obvious. Banks make money two main ways on a credit card: interest charged on carried balances, and interchange fees collected from merchants every time you swipe. A confused customer who doesn't understand utilization tends to carry a balance longer, generates more interest revenue, and rarely calls to negotiate anything. A customer who fully understands the system asks for credit limit increases, pays strategically around the statement date, and costs the bank money in interest they'll never collect. So the offers that reach you get dressed up to look personal. An exclusive offer just for you. When really, you were sorted into a bucket the moment your utilization number last updated, and that offer was generated for the bucket, not for you individually. The system rewards the people who already understand it, and stays deliberately quiet around everyone else, not through any single dishonest act, just through the absence of an explanation nobody's required to give you. So let's fix that right now. If understanding the system is what moves you up a tier, then here are the 3 exact moves that do it. And the first one is something you can do this week. So here's how you actually move doors, starting with your very next statement. Quick, honest note before we get tactical. This is education, not personalized financial advice. Everyone's numbers and situation are different, so take what fits yours. Move 1. Get your utilization under 10% before your statement closes, not before your due date. Here's why that distinction matters. The balance the bank reports to the credit bureaus is whatever your balance happens to be on your statement closing date, not the balance after you pay it. So if you pay your card down a few days before that closing date instead of waiting until the due date, the bank reports a near zero balance to the bureaus, even if you use the card heavily all month. Move 2. Request a credit limit increase every 6 to 12 months, and ask specifically whether it requires a hard inquiry before they run it. Most major issuers will do a soft pull if you simply ask, and a higher limit with the same spending instantly lowers your utilization percentage, with no ding to your score at all. Move 3. If you've been a loyal customer for over a year with an on-time payment history, call and mention a competing offer you've genuinely received in the mail. Banks maintain real retention budgets specifically built to match or beat outside offers, waived fees, lower APRs, bonus limits, but only if you actually call and ask, because they are never going to volunteer it to you first. And there's a bonus move worth knowing if you're just starting out or rebuilding. Becoming an authorized user on a family member's older, well-managed card can add years of history and a low utilization ratio to your own report almost overnight, as long as that card genuinely has a clean payment record. It can help enormously, but it can just as easily hurt you if the primary cardholder ever misses a payment or runs the balance up. 4 tiers, 5 factors, and the one that moves fastest, utilization, is completely inside your control, adjustable in a single billing cycle if you know when to make the payment. None of the 3 moves we just covered require good credit to start, a higher income, or a single dollar you don't already have. They require knowing when your statement closes and being willing to make one phone call. The bank isn't going to explain any of this to you because a customer who doesn't understand the system is, quite simply, a more profitable customer to have. Now you understand it. If this changed how you think about your own credit card statement, hit subscribe. We break down exactly how these financial systems really work every single week, so you're never the person a company profits from simply misunderstanding. And I want to know, what tier do you think you're actually in right now? Drop it in the comments. And if you try the statement date trick from Move 1 this month, come back and tell us what happened to your utilization number. That's how the system really works once you can actually see it. This is Rexonomics.